Going on, small business owners? Chris Charles here with spreadsheetsforbusiness.com, and back with a video that's going to be in a little different vein than my previous ones. Previously, I talked about budgeting and also a video in there on forecasting, which forecasting ties in pretty obviously with budgeting. When you're looking to the year ahead, you're going to have to make forecasts about revenues, expenses, those sorts of things. So same when you're examining a project as in capital budgeting, you're going to have to look to the future. But so this one's a little different. This is on expected value and business decision making, and it's takes place in a spreadsheet here, like really all my videos, most of my videos, I should say. I got a couple for church strategic planning that didn't use a spreadsheet, but anyhow, it's a simple one worksheet workbook, and it's pretty straightforward, not a ton of information to input, and should make for a pretty quick video for once. If you look through my video history up until this point, notice most of the videos are close to an hour or over an hour, and this one, hopefully I won't be eating my words here, but should have this one done pretty quickly. I'll also say that as always with all my videos, I like to put a shortcuts down in the description there, along with a link to the post on spreadsheetsforbusiness.com regarding expected value. So with all that said, let's get into it here. So okay, what is this an expected value analysis? And it's really just a way to select the best course of action when you have several, and this is important, mutually exclusive alternatives. Okay, so mutually exclusive means that only one can be selected. So it's a way of ascertaining which of the decisions is best from a profitability standpoint, or just optimal. Let me put that, which is the optimal decision. If you're trying to minimize costs, then you wouldn't want to maximize costs, you'd want to minimize them. But if you're talking profit or revenue, you want to maximize it. We'll get into that a little more later. And there are three things that are looked at when doing expected value analysis, and that's the probability, the dollar impact, and the initial investment amount. Those are really just the three variables, more or less, and like I said, it's pretty simple, pretty straightforward. The first thing you're going to do here is keep in mind, for this example, there are only three different decisions. We got A, B, and C here. And this time I did remember to zoom in on my spreadsheet. I forgot to do that on I think it was a forecasting video, or it might have been another one, but did zoom in here, so hopefully that should be nice and easy to see. But looking at each of the decisions here, and just drop a description in there. Now obviously every decision you're faced with isn't necessarily going to have three alternatives, but for the purposes of illustrating the expected value concept and trying to keep things relatively simple, just kept it to three. So you'll see there the place to put three descriptions, and then the initial investment amount. So in this case, in this example, the first decision we look at is to purchase 2 new pieces of machinery. Second is to purchase 1. Third is to purchase no new machinery. And we've got different investment amounts for each decision. Of course, purchasing 2 is going to cost the most. Purchasing 1 in between, and not purchasing machinery in this case isn't going to cost anything. That might not necessarily be the case. It kind of like, when I encourage people who look at my content to do no matter what it is, whether it's the strategic planning or forecasting or that, to really think through everything thoroughly. I talked about this in video I put up the other day on church capital budgeting, that you want to think about like second and third order effects, this sort of thing. So in this case, what I'm getting at here is that the investment amount for not purchasing machinery, well, obviously the first thing we say is that it's 0. But if you think about it, maybe not purchasing machinery would cost more in maintenance for the existing machinery, or would cost more in scrap or additional labor, something like that. So anyhow, we won't worry. We can circle back to that and kind of type in some amounts there just to see what effect it has on the outcome. But like I said, always it's part of the battle in all these topics that I cover is really just thinking them through thoroughly. That's half the benefit. Besides the output, the quantitative output, the numbers, and everything. I mean, the biggest part, or like I said, I don't know, half the benefit, however you put it, though, is just thinking things through thoroughly. So anyhow, move forward with this example. You can see that, like I said, we'll just leave that at 0 for now. So okay, those are 3 decisions. That's the 3 names and amounts there. So we move on to the scenarios. Okay, so again, only 5 scenarios here. In theory, with any decision, there's an infinite number of scenarios that could take place. That's not practical from an analysis standpoint, so we're kind of lumping them together. But keep in mind, it doesn't have to be 3 decisions when you're doing an analysis like this for yourself. It doesn't have to be just 5 scenarios. You could do more, could do less if you wanted. Obviously, you need to have at least 2 decisions, or there's not really any point in doing this. But the 5 decisions we went with in the example here are overhead costs will be cut by 50%. By 30%, by 10%, overhead costs won't change, or overhead costs will increase by 10%. So those are 5 scenarios. And if you look at the worksheet here, basically by doing this, we've created a matrix. We've got decision A information here, and then we've got cut scenario information going across, and where they meet is where we'll put the probability and the dollar impact. Okay, so probability is tough to guess at. Here's a simple rule of thumb when it comes to estimating probability for any group of things. It has to equal 100%. Okay, that's if you don't equal 100%, then you've still got a little work to do, a little tweaking. It's not something that people are inherently good at, estimating risk, probability, however you want to put it. But so don't beat yourself up too bad. Okay, I'd say go with your gut feeling. That's the beauty of making models like this, is you can circle around and change it. All the work's done in terms of the formulas. This, you could change these probabilities right here 100,000 times, and Sheets in this case, or Excel, or whatever you're using, is just going to keep spitting out new numbers. That's what it does. That's the beauty of it. You can test things. You can run through different scenarios and toy with things until you feel comfortable with what you have. So for each decision, you're going to look at the probability of that scenario happening. We look here, decision A, purchasing 2 new pieces of machinery. It's kind of, we think our biggest probability is just to cut overhead costs by 10%, put that at 35. Realize that there's a small probability overhead costs will go up, a smallish probability that overhead costs will drop by as much as 50%. So, that you feel comfortable with the probabilities for a given decision, you move on to the next one, and it's kind of a similar distribution of probabilities here. For decision B, just there's less of an impact with only 1 new piece of machinery, of overhead costs getting cut by 50%. Same with 30. Everything, I better check myself here. Did all these equal 100%? I'd sure look foolish if they didn't. Okay. Yeah, but a greater likelihood of them staying the same and a little bit of them going up, since we only have 1 new piece, not 2 new pieces of machinery. And then decision C, again, for the sake of keeping things simple. We put 100% on overhead costs staying the same. Might not be the case. Might go up if new machinery isn't purchased, or not. It just all depends on the situation you're analyzing. So you'll notice too, we put the same dollar impact across here. I say we, I mean I did. Use the same dollar impact across all three decisions because, the impact's the same. If overhead costs being cut by 30% isn't going to be different for decision A, the dollar impact versus decision B. 30% is 30% of whatever they are now. Okay, so even over here on decision C, where there's 0% probability, we kept those dollar impacts the same. I probably should make that to where you just enter it. Well, and I made this worksheet back in like 2009, 2010, something like that. So it's pretty old, and I can't say for sure what my mindset was at the time, but I would guess that it would just be confusing if people just entered. It should probably be dollar impact over here right by the scenario and then probability. So if and when I get around to tweaking this someday, I'll probably do that. But for the meantime, just make sure they're all the same. And actually, it fills it in. It's going to pull off of that. So if that got changed to 2 million, should see that at least here. Yeah, trickle across. So. All right, so I was, like I said, I'm getting back into my 2010 brain there. I remember what I did. So I was thinking the same thing, same time. Anyhow, hopefully dollar impact makes sense in light of that. Okay, so then we move on to output. That's it. That's it for the inputs. Not much there. And once you're done and you like I said, pick your outcome desired. In this case, it's drop-down menu, so we want to maximize expected value or minimize it. Again, you might want to minimize it if you're talking costs rather than, revenue. Now, in this case, well, we do talk about costs here, but let me back up for a second before we get to output. You'll notice this field here, expected value, gets calculated, okay? And what that's doing is simply taking probability times the dollar impact, all right? So 22.5% times 870,000, that's the expected value. 35% times 290,000, and it's actually, let me remind myself here. Okay, right, it's taken the difference. See, I told you it's been a while since I've done this. Hopefully in the future, making a worksheet and then recording a video on it will happen in a little shorter time frame than 9 years. But it's taking the dollar impact minus the investment amount times the probability, okay? And it's giving an expected value for that particular scenario. So with decision A, since cut overhead costs by 10% is 35% likelihood of happening, dollar impact's 290,000, okay? So the most likely scenario isn't likely enough to have a positive expected value because the dollar impact's less than the investment amount, okay? So it's 290,000 to come up with this amount here. 290,000 minus 400,000 times 0.35 gives you the 38,500 negative expected value, okay? So it does the same thing here. In this case, there's a 30% chance of overhead costs getting cut by 10%. That expected value is the same, of course, or the dollar impact's the same, of course, 290,000. But since the one piece of new equipment only costs 250, you got 290,000 minus 250,000. So positive expected value. Then we take that times we know it's going to be positive because the impact's greater than the cost, the benefit's greater than the cost, and then it's times 0.3, that's 12,000. Now in the case here of decision C, of course it's 100%. We know what's going to happen. We don't purchase new machinery, no dollar impact, no amounts there. And what happens down here, total expected value, is just the sum of all the expected values above. Okay? So all of our probabilities in there for each scenario and the expected value for each scenario, and this is why we need 100% in probabilities, so we cover each scenario, we have our expected value. Okay? 185,000 for decision B and 122,000 for decision A. 0 for decision C. So it should be pretty obvious from there which one's going to be ideal, the one with the highest expected value. You know, not doing anything has an expected value of $0, but purchasing equipment has positive expected values. So, you know, so we go back down here to talked about earlier. Take the outcome desired, which is maximize expected value. Okay, and you can choose, you know, maximize or minimize. And you'll notice if I change it to minimize, the optimum decision is to purchase no new machinery. But that's not what we'd want to do in this case. We want to maximize expected value. Like an example of minimizing expected value would be, like I said, it would revolve around cost. So like say all your scenarios were going to equal an increase in cost, okay, rather than saving on overhead. Overhead would go up by 50%, overhead would go up by 30%, 10%. Okay, then the dollar impact would be negative, not positive. See, like it is here, negative 290,000 because it's an increase of 10%. Then, you know, if you weren't factoring in revenue or cost savings at all, I should say, this isn't revenue, this is cost savings, then you'd want to minimize expected value. You want to minimize the, you know, expected increase in costs. So if you are facing decisions where it's going to cost more no matter what, and revenue doesn't really factor in, then you'd want to minimize. Okay? So the optimum decision here is just based off of maximize or minimize, which one it is. Obviously it's purchase one piece of machinery because it has the highest expected value, and we were trying to maximize expected value. Okay, and then just brings that total down here, and that's really all there is to it. Like usual, I include a handy dandy chart just to illustrate the most important concepts from the workbook, and this one is short and sweet, like I said, so it's pretty straightforward. Just charts those expected values. You can see number one here at 185,000, and not much to it. Hopefully you can kind of see how the line of thinking here, you know, basically evaluating decisions against each other and trying to choose the one that, you know, the optimal decision. It's a pretty simplistic way to look at things. Not every group of decisions is going to lend itself to this, but you know, for those of you particularly that are kind of like maybe this whole you know, spreadsheets and all that isn't really your thing, and some of it seems complicated. Like I said before, I've tried to keep things simple to where, you know, it's basically just like software. You put in the inputs, the hard work, you know, is done on the back end with the formulas and everything, and it just spits out answers to you. That's what I aim to do. So if you have any input on how I could do that better, by all means let me know with a comment on the video here, a comment on the post, or, you know, wherever. I appreciate the feedback. So I'd be interested, you know, just some thoughts on what some particular decisions might be that would be conducive to this kind of analysis. Like I said, went with a pretty simple example here of new pieces of machinery to 1 or 0. What else is the type of analysis that small business might run through this? This is kind of like a lot of my sheets kind of geared around manufacturing, just because of manufacturing's complexity. If I create them to accommodate manufacturing's complexity, then they can usually be pretty easily adopted into businesses that don't have as many moving parts. A service business, a retail business, or something like that. So yeah, let me know about those decisions down below. Let me know how I could make these sheets more user-friendly. If you're watching this, and I always end each video, if you stuck with me this long. This one shouldn't have ended up that long, hopefully 15 minutes or so. I didn't check to see when I started, but yeah, those like and subscriptions really help. It's a way to give a free tip, and it's much appreciated. So thanks for watching. Until next time, see you.